Hello everybody. So you may remember that a few weeks ago I made a video about STEM, and I was saying that I wasn't too sure what to do, that it was a very hard stock to decide on. There's so much going for it, and STEM could be a 10x, but there were a few things that I wasn't too confident about. And the last quarter was just outstanding. The stock went up 12%, and it led me to reevaluate a lot of things about STEM, and I have changed my decision. And so this is the topic of this video, reevaluating STEM. So let me go through quickly why I love STEM, what I think is great about STEM. So first of all, I love STEM because I love the energy revolution megatrend. This is a megatrend where the grid is getting disrupted, and it's getting disrupted for so many reasons. One of the ways that it's getting disrupted is the end of peaker plants, because you don't need a coal or natural gas peaker plant anymore in the grid if you have battery packs like this and fields of battery packs, because these battery packs can turn up more energy on demand depending on whatever the grid asks you. So if everybody turns their AC on at once, these battery packs can just unload so much energy into the grid without any plants needing to be fired. And because of that, I believe that the battery packs like these giant ones, are a major competition to any form of legacy peaker energy plant. So that's one major megatrend. Utilities have strong incentive to set these up. Another megatrend is solar. So solar is the cheapest source of energy that you can get today for electricity. I've made so many videos on the channel about that, explain in depth why. But the problem with solar is that it's intermittent energy. And in order to unlock the full value of solar, that is when there's no sun at night and when there are a lot of clouds, in order to unlock that full value and make solar reliable for a utility company, you need battery packs like these giant ones. And battery packs unlock the value of solar fields. And lastly, battery packs are very important if electric trucks are going to be a thing. And electric trucks, in my view, are absolutely going to be a thing because they are way cheaper, just like electric cars are way cheaper. Electric trucks are way cheaper to operate. But to charge an electric truck, the grid can't handle it. And so what that means is that since the grid can't handle it, you need to have these battery packs next to your charger as an industrial facility. The battery packs takes in energy from the grid for, few hours per day until it's charged up, and then it's able to unload all of that energy into an electric truck with a megawatt charger. So you can imagine these batteries working as condensators, right? They would take in energy from the grid from 3 hours to get charged. Once a truck comes in, you fuel the truck per se with a megawatt charger or 500 kilovolt charger, a very, very powerful charger, and you dump all of that energy all at once, and that's very powerful stuff. This is the way that we're headed, in my view. Moving on is another thing, another reason why I love the energy revolution so much is that this trend still eludes a lot of people. Still, a lot of people do not understand this trend, which is why I think so many of these companies are undervalued in that field, including STEM, including Tesla, I could argue, but they are undervalued. Why? Because most people think linearly, and people have a very, very hard time seeing the exponentiality of these technologies. These technologies ride the same cost curves as computing. In fact, battery cost curves and the declining of battery cost curves is the very reason for the revolution we're seeing right now in electric cars and Tesla. If you go back to the early history of Tesla, how did they do it? Well, they took batteries from laptops, and they rode the cost curves of the laptop and of the personal computing revolution. So the cost curve of batteries is such that it follows Wright's law, which is a spin on Moore's law, but it's the whole idea that the cost of producing a good decreases at a constant rate as production increases. And this is the reason that if you look at batteries, they've been cut by 10 over the past 10 years, and they may be cut by 10 again within the next decade. But if it's not 10, if it's a 5, we'll take it. That would be insane, right? And the same is true for solar cost curves, right? The cost of solar has become so cheap that you have a bunch of very serious studies that show you that solar sometimes is cheaper than a wall covering. Like, it's cheaper than plywood sometimes, which is absolutely crazy. That's how cheap solar has gotten. And the cost of solar, by the way, may be cut again by another 10, right? And lastly, electric trucks. Electric trucks are going to get cheaper for many reasons. One of the reasons, of course, is that there's very few moving parts, but also we have learned a lot about scaled manufacturing. Thanks to electronics, we got much better at manufacturing, and we make very, very large plants today, which allow you to manufacture things at a scale that is never seen before. And that's why, you get costs going down as the scale of the factory increases. And by the way, this is a factor that's true for electric trucks, but that's a factor that's true for battery making facilities and solar making facilities. These facilities are scaled up so much that you have your own cost reduction curve that comes from the scaled manufacturing itself. That's why every single company, is not just Tesla, but every single company is rushing to building a mega factory, because if you increase the factory size, you also get an exponential cost curve down. So these are the reason for that megatrend. Moving on, there's some risks to STEM, right? There's some risk. So we have to know, of course, that STEM is an installer. It's an installer first of, at least in their revenue. Like when you look at STEM's revenue, you're like, oh, they're just an installer. They're a leading installer of Tesla megapacks and Chinese megapacks. And that's not a good business to be in, installing these megapacks. It's a commodity business with commodity margins. The margins, 20% gross margin is what they're guiding, and that would be tops, like really, really tops. It's a very capital intensive business because you have to pay for a good chunk of the megapacks up front, right? You have to put 30% down, so it's very capital incentives. And it's also a business that's being hurt by supply chain because it's really hard to procure, and you have to wait until 2025, for example, if you want a Tesla megapack. And that puts STEM in a very odd spot, actually, which is interesting because they're both, if you look at Tesla versus STEM, in this case, and STEM is of course an installer, so it is enabled by Tesla and enabled by Chinese makers of Megapack. But if you look at STEM, they're both a great customer of Tesla, as well as a competitor of Tesla. That is an odd spot to be in. And the reason why I think STEM has tremendous opportunities, of course, is the Athena software. They were the first to launch that software, and the software has features that are similar to Tesla Autobidder. I actually ran a full comparison of Athena and the Tesla energy software, which they call it, which used to be called only Autobidder. But these two softwares are pretty much competing. And why is that? Because software is the most important part of that business. Software is what runs the megapack, and you need software to run those megapacks because software handles maintenance, it handles battery management, making sure the battery is going to last decades, right? In the way it unloads charging, uncharging, exporting, importing electricity. It mimics peaker plants, right? If you're replacing a natural gas plant in your grid by battery packs, the battery pack needs to mimic and conform to the old way the grid used to work. And it also helps you trade energy and sell energy in a resale market. It helps you build a virtual grid. This is so important, the software. These are the software that are going to run those megapack-based utilities in the future. And again, in this situation, Athena versus Tesla, that's pretty much a duopoly. And it's a very desirable position to be in. So that's a big plus for STEM. But to me, there's really two things that make STEM special and that would warrant an investment. And I am sad to say that even though there's a lot of value on the engineering of project from a societal side, from a society's advancement side, and it's cool. That's true too. I mean, there's a lot of engineering value to setting up these projects. It's at its core, it's still just construction. And even though that skill is valuable, it is also not where the money is. So that's why I say I don't consider that a skill that you can use to justify an investment, because that's not that's not a skill that makes money, right? You can have the best skill in the world at something. If it doesn't make money, well, that's going to be valuable in non-economic ways, but it's not going to be valuable in economic ways. And obviously, installing these projects makes very little money, which is why if you look at STEM and why they're moving upstream, for example, they're doing that such that, well, the engineering is done by the utility company going forward, and they're just trying to sell the software. So valuable from a societal standpoint, cool from an engineering standpoint, but really not where the money is. What I place the value on is the Athena software. That's where the bunch of the value is, because you have learning curves, you have network effects, the software connects to each other, then you create virtual grids, and you have by learning curves and also a learning moat, right? Because once employees learn the software, they know how to use the software, it self-perpetuates the need of the software. I think the software is very valuable and very direct competition to the Tesla energy software, as I've stated earlier. That's one thing I place value on. And then another thing that I'm increasingly placing value on, I've done a few videos on STEM. That's the first time I bring this up, because on the call we discussed their relationship with China. Yeah, they are developing strong relationships in China, which is what we call Guanxi, which is very important in order to do business in China. And this may seem odd to say that, and perhaps the value of this relationship would not be as valuable if you're talking about buying fashionable clothing or something like that. But when you're talking about buying megapacks that require very complex contracts, very complex specification, that require a lot of time to be invested in signing those contracts, and require a lot of trust, because they are $2 million, right? I mean, between 1.5 and $2 million, these megapacks. So it requires a tremendous amount of trust. That is not quite a moat, but a business that's very tough to get into, that takes time to get into. And so it would be very hard for a utility to develop that relationship with Chinese suppliers, to curate a list of reliable suppliers. STEM is doing that, and that has value, in my view, from a networking standpoint. These relationships have value, and that's what you get with STEM. You get these relationships that the management team has set up between them and the Chinese manufacturers. And on the call, they were talking about spending 2 weeks in China, the CEO himself working on these relationships. So that's the two main things that I think are very unique to STEM and that I place a lot of value on. Let's now talk about the exciting part, which is finance. Let's talk about finance. So we have heard the following guidance, which they've guided again, and I'm going to assume this is a 5-year guidance. That seems about fair to me. But they've guided us long-term for guidance. Yeah, right, 5 years is usual for long-term. They said they're going to grow hardware revenue growth is going to be 30%. I'm taking the midpoint in all of this calculation. And for everything, I'm going to take the midpoint. And services, they said 70. I took 70% here, so I guess I was a little bit conservative, but that's okay. So roughly, I'm taking roughly the midpoint, but erring on the side of caution. Okay, and so that's what I'm taking. And also, for the sake of simplicity in this calculation, I am going to be using the guidance, the year-end guidance for 2023, which is $600 million in total revenue by year-end. And the reason why I do that is because they have seasonality in their revenue, where they book a lot of services in the fall. So now that I've put that out of the way, what kind of breakdown do we have? Well, the breakdown as guided is as follow. So in December of 2023, we are going to have the following breakdown. So hardware sales should be 515 million, software sales should be 85 million. They previously guided the following gross margins. On hardware, we know from the quarter prior to last quarter, they had a beautiful chart where they guided it. 20% gross margin is what you can expect long term on the hardware installation, and I'd say that's pretty high for that product. And on software, that's 80% gross margin is what you expect, and I'd say that's actually low for that type of software. So you can see very disparate margins, such that software is quickly going to become just so important to the business. And of course, this is what they guided. The growth rate per annum, 30% for hardware, 70% for software. So now that we have this, we can model the gross profits for STEM. And in my valuation of companies, this is important, gross profits, because that's what I care the most about, because I trust that companies will invest their proceeds beyond gross profit in a shareholder consistent way, or at least that is a more qualitative analysis that I make, and not a financial analysis. I want companies to invest money back into the business once they've achieved that gross profit line. So in a nutshell, this is the chart that I get. Let me zoom it a little bit. But in a nutshell, you can see that gross profit for software is still going to be lower in 2023 and 2024, but then it will quickly outpace the growth of hardware, which has always been the business model, because once they sell a piece of hardware, they sign a 20-year contract for servicing that piece of hardware and providing the software for that piece of hardware. So this is why software is going to grow much faster. And over time, this is a company that, in my view, is going to get valued more and more as a software company. So going on with my calculation. So if you're new to the channel, my calculation that I always use is enterprise value over trailing 12-month gross profit over revenue growth. And I am asking the question, how much am I paying for each percentage point of growth? This is a growth-oriented, this is my spin on the Peter Lynch PEG ratio formula, but I use gross profits instead of using earnings, because I typically don't like earnings. I think they're extremely misleading because of GAAP, and I almost never look at earnings when I analyze my stocks. That's the way I do it, because GAAP is for paying taxes. Anyways, that's not the topic of the video. Let me get back to this. So, for the sake of simplicity, I'm taking 2024 enterprise value over gross profit over revenue growth. So, enterprise value was 103. If you followed the channel, you'll see that they in my spreadsheet, this company is getting penalized because they raised more debt, right? So they're getting a little penalized. But I have to stay consistent. Enterprise value, of course, I have to count debt against them. So enterprise value takes into account the debt, which I think is more fair. So the market cap is actually $670 million, I believe. So some debt. So therefore, enterprise value is $1 billion. The trailing 12-month gross profit, which will be trailing 12 month, right? In December of 2023, that will be trailing 12 month. That's $171 million. And then I went back and calculated the blended revenue growth implied by these disparate growth rates for both hardware and gross profit. Remember, they have different revenue growth rates. So when you go back and calculate, that implies a guidance of 36% revenue growth. You can see this is conservative guidance because this company has grown much faster in the past. So that's pretty conservative guidance they've been giving here. So working that out, applying this formula, I get a 0.16. And if you are familiar with my spreadsheet, you will be able to tell me and see that we're not paying much for each percentage point of growth. Not much at all. This is my spreadsheet where I analyze all of the stocks that I cover on the channel. And you can see with this updated guidance, the valuation has barely moved, moving from 0.14 to 0.18. That has barely moved. STEM is still between what, 4 and 5 times cheaper than Tesla and Enphase, which are my stocks in that same sector. So compared to the sector and compared to the potential of the sector, this STEM stock is extremely undervalued. And you can see even compared to the average of my spreadsheet, it is highly undervalued. And the sector is riding a fundamental megatrend. This company is riding a fundamental megatrend. Of note, and assuming that you don't get any valuation change, right? Any valuation compression or expansion, even though I think this company will be much more subject to valuation expansion and not compression, given that the nature of their revenue is going to move to software. But look at this, right? Numbers don't lie. If you project that to 2027, you're going to have 5x more gross profit in 2027 than in 2023. So that means that if the valuation stay the same, that's going to be a 5x, right? I mean, if your enterprise value over gross profit stays the same over 5 years, that's going to be a 5x investment advice. But that's why I'm very compelled by this company. This company has great growth. So, will I buy the stock? This is the major change. And remember, there is a sister video to this video that I published a few days ago where I go even more in depth in the conference call on all of my takeaways. So yes, I will be buying the stock, starter positions to small position. It typically takes me years to accumulate a full position. I'm very, very nimble in my portfolio. I'm nimble mostly because I like to buy a little bit of stocks every day. That's why I'm nimble. I like it. I enjoy it. That's why I have this YouTube channel, right? It's like I enjoy stocks. So to me, if I buy everything all at once, then there's no. Anyways. So why am I buying the stock? Service revenue growth is picking up, and it's clear that it's picking up. The guidance is picking up. The numbers show it picking up. The thesis is on track, very much so. Then we are moving up on their customers, and they are pushing their customers to procure batteries from themselves and do the design from themselves, which means that they're slowly moving away from this whole construction of, from this old construction company that they kind of are. They're a construction company for storage system. I don't want to invest in that. Them moving up to the utilities and to bigger customers and focusing on bigger customers that have their own procurement services, their own engineers, means that we are moving away from that low gross margin business, which I like. Then, and this was I think this was actually the trigger that made me reanalyze the stock, is they did do a master move with that green bond. If you go look at the financial, the new green bond that they issued, they were able to buy back their old depressed debt at a very steep discount. I thought that was a very, very, very master move. So you save tens and tens of millions of dollars just for a slightly higher interest rate, because it's a green bond. Because green bonds, you have a lot of people in the market who are willing to finance them at lower interest rates, right? And I just think this is very astute. And by the way, it expanded the maturity of the bond. The maturity is April 2030. So lots of runway. So I'm very confident in the CEO, and the runway, I calculated not in this video, but I calculated in my former video on STEM, the runway is about 10 years, of runway at current cash burn. Absolutely great. And of course, the cash burn is going to go away eventually as these growth rates manifest themselves. It's the cheapest stock in my energy revolution sector. So I typically put only mild credit to cheapness, because a stock can stay expensive all the way to a 10x or a 20x. It can be expensive all the way. So I tend to put a lesser weight on that, but that's still a nice to have. But what I think, and these are the last 2 points, oftentimes you gotta get risk-adjusted risk. One of the way to have risk asymmetry or an asymmetric bet, take a risk, but where you think the benefits outweigh the risk, is to know an industry. And this is my favorite industry, energy. My conviction in electric vehicles, my conviction is in grid storage is extremely high. So therefore, the uncertainty for me is much lower, even though this is a small cap stock. And when I look at this, they are 1/600th the market cap of Tesla. I mean, think about that. And of course, this company is in no way, shape, or form comparable to Tesla. But do they have 10% overlap with, say, the megapack business of Tesla? If so, they shouldn't be trading at 1/600th the value of Tesla, because the megapack thesis of Tesla, which is not in their stock price at all, in my view, is a tremendous opportunity. And so I think they have a multi-bagger potential, or at least a quicker multi-bagger potential than, say, Tesla, even though Tesla, in my view, is a clear multi-bagger as well. not investment advice. And lastly, this megatrend is my highest conviction. It's the trend I spend the most time studying and thinking about, and it just makes sense. It just makes sense for me to buy this stock, starting slow, and I will be slowly adding and joining the many commenters on my YouTube who happily own this stock, and I'm happy to join. So thank you so much for watching this video. This was not investment advice, just entertainment. I appreciate all of your likes, and I appreciate all of my subscribers. Have a wonderful day.